All right. Well, thank you everyone for joining us today. We will be covering how to understand the basics of self-directed IRAs, and then specifically our case studies today will focus on actually lending out of an IRA. So issuing notes, buying notes, the like, we will be covering today. For those of you just joining us, please do make sure if you have any questions, type them into the chat box. I will address them throughout the presentation. Don't feel like you have to wait till the end. I will do them throughout, and sometimes they actually do help drive good content for everyone. So get the questions out there coming. I will be happy to answer them. So a little bit about myself. Me as a presenter today, my name is Alex Perney. I'm a business development specialist with Directed IRA. I graduated from Eckerd College down here in sunny St. Petersburg, Florida in 2011 with my degree in business administration and finance. I did investments for Advanta for about 4.5 years. So actually handling the actual transactional side of things, doing processing of different types of notes, private placements, real estate, doing thousands of them over the years. So I have a good basis of knowledge for that. I'm also a certified IRA services professional with the American Banking Association, and I am also a member of the American Institute of Certified Bankers. So not only can I answer a lot of questions regarding the investment side of things, but I can also answer other questions regarding plan type choices, how to get started with this, and also general IRA questions and 401ks as well. So if you have something that falls a little bit out of the purview of what we're going to be covering today, feel free to type it into the chat box, send me an email. I can certainly get that question answered for you. I'd be happy to do so, whether or not you're a client. More than happy to help. As always, before we get started, we need to give a little bit of a disclaimer. Advanta IRA and our employees, we do not provide any tax or legal or investment advice, nor do we endorse or promote any product. Everything I'll be presenting here is for educational purposes only. We do encourage everyone, please do get out and maintain a good relationship with a tax advisor or attorney, someone that can properly advise you in this context for the investments that you're looking to do, as we will not be able to offer any sort of legal advice or endorsement for ultimately what you decide to do with your self-directed account. Here's a little bit of an agenda for us today. We're going to get into a definition of what is a self-directed IRA, go into a little bit about us as a company, different types of self-directed plans, the investment options and case studies are kind of one and the same with that. So we will be doing that. I just noticed someone had raised their hand. If you do have a question, again, please do type it into the chat box, and I will get to that. So a self-directed IRA, how is a self-directed IRA different from any other IRA? Well, an IRA in and of itself is the same in its DNA at anywhere that you have it. The only difference is what those administrators will let you invest in. So big companies like Charles Schwab and Fidelity, they're selling you investment products. That is how they're making their money. They are selling you a product and you are holding that product with them at their company. So they don't really have any interest, nor do they have any desire to let you invest in alternatives that may fall out of the purview of things that they're directly selling you. We at Advanta specialize in holding things that our clients directly choose, that they are taking control of and utilizing and making the purchasing decisions on. So things like real estate, private lending, mortgage lending, private placements, different types of investments into startups, and anything else that you can really kind of think of that might qualify as an investment in the most general sense of the word can typically be structured in a way where you can create tax-free or tax-deferred gains within your IRA and avoid all sorts of things like capital gains taxes and ordinary income and things like that. All right, Karen, I got your question, and I will address that here in a few moments. Let me just get through the intro, and we will cover that here a little bit later on. But thank you for typing in that question. So self-directed IRAs, they can invest in a much wider variety of things than you're going to be seeing at other investment providers, because we're not providing the investment. You're bringing it to us, and we are helping you structure that, entitle that, and ultimately fund that investment properly underneath of your IRA. So a little bit about us as a company. We've been in business here since 2004. We maintain currently a little bit more than this. I need to adjust the figure. We maintain about $700 million or $750 million in client assets, and that is, helped directly by our great network of CPAs and attorneys. We also offer a dedicated service and local feel to any of our clients, no matter if you're located near us in our offices in Atlanta or in our main office in Largo, Florida. We offer a dedicated account manager program where every single client, regardless of how big your account is or how small your account is, has a dedicated account representative that will be there for you to answer any and all questions, to process your investments, and to be a resource for you to help you, guide you through the self-directed process. As I was saying earlier, that's a job I did for our company when we first instituted it and helped build that type of program. The original account managers that started that program with us, we're all still here today. So we have a great retention of those employees, here to help you out, and we continue to grow that basis of awesome account managers that are here to help you with any questions that you have. The process for getting started with a self-directed account, sometimes people get a little bit burdened by the fact that they think, oh, well, it's going to be hard. It's going to be, a bunch of steps. It's just so easy with everyone else. That really isn't the case. It is incredibly easy to get started self-directing. The only thing you need to do is really just have the conversation with us, and we can certainly help you get started with it. It just starts with opening the account, completing the account application. In that application, we then in turn will submit a custodial transfer request to your IRA administrator, or we will have you complete a rollover form for us to accept funds from an old 401k from an employer. And then once the funds arrive here, you're already working with your account manager to get everything set up for your investment that you're looking to do, or you're talking to them and opening up those dialogue channels to make sure that everything is set so when the money gets here, you're ready to invest. So it's 3 easy steps. It's very easy. And I do encourage people, make sure that you look at this objectively because it really isn't a hard process to get started with. We like to provide a lot of things to our clients and non-clients alike. I do know that everyone attending this webinar today is certainly not a client of ours, so thank you if you are not a client of ours. And if you are a client as well, thanks for attending to get some more information. But we offer all of our events at free of charge. So our seminars, webinars, our networking events. Rose, one moment. Someone is having an issue with sound. I just had someone indicate that they were having an issue with audio. Is anyone else having audio issues? Just if a few people could sound off in the chat box and let me know that. Okay, great. If one person's got it, then I'm assuming it's everyone else is fine. We do everything in our power to make sure that you get the correct information in a timely fashion for free. So we offer seminars, webinars, networking, lunch and learn events where we have lunch and do a presentation similar to this in our office so that you can, come in and get that local feel if you're looking for it. We also do those in our office in Atlanta. We offer our Advanta On Demand, so short videos to help you understand everything that is going on with the self-directed IRA, and also industry updated blogs as well. So keeping you up to date on the overall legislation and different things coming down the pipeline and changes that might be affecting you and your ability to direct your investments. We like to make sure that we keep everything up to date for you as well. So with that said, please do not hesitate if you have any questions. Schedule a consultation with us. It's always going to be free. And what I tell a lot of people is that, use our service as a way to help save yourself money. If a CPA or an attorney is going to charge you by the hour, get that 45-minute phone call to us. That's going to be free to help you understand what questions you need to ask. So that way, when you do call these people that charge you by the hour, you can really help try to mitigate your costs because you're not paying for as much time, because instead of going in there and having an hour of billing that they're charging you to figure out the one question you needed to ask, you've gotten that out of the way with us, and then you're only going in there and asking them one question. So we like to be a resource for you. Whether or not you're a client, it doesn't make too much of a difference to us. We always are there to help you and, ultimately help you understand and make the best decision possible. So with that said, there's different types of self-directed plans. All IRAs in essence are going to be the exact same account, as I said. It's just a difference with what the administrator will let you invest in. So with that said, there's a bunch of different types of plans out there. Now, in this presentation, I don't go over too much on how to choose the right one, but we're going to give you a basic breakdown of the different types of plans that you can self-direct and how much money you can add into each. The two most common types of IRAs are the traditional and the Roth IRA. The big difference between the two is considered in the beginning and the end of the account. Both accounts grow in the exact same tax-exempt manner. The only difference is that with a traditional IRA, you get a deduction for adding money into it, and you have to pay taxes when you take distributions personally out. All of the investments and earnings are going to be non-taxed throughout the entirety of it. One moment, someone is having issues with sound. So the only difference that you're going to be considering between the two of them is when you're going to be paying taxes. Now, in a Roth IRA, you pay tax on the seed that you plant, but unlike in a traditional IRA where you're paying tax at the end, you pay no tax for any qualified Roth distribution. Okay. Now, those two plans are certainly the most common, the most widely recognized in the marketplace as to what you are going to see when you say, hey, I'd like to open up an IRA. However, there are two very distinct plans that you can utilize, especially if you are a self-employed individual or you are someone that operates as a single member. I shouldn't say single member. If you operate as a sole proprietor or someone that has their own business, you could also utilize self-direction in a small business plan. The two small business plan type of IRAs are the SEP IRA, which is the newest version of the small business IRA plan, stands for Simplified Employer Pension IRA, or the Simple IRA, which inherently is anything but simple. So the name is not the best on there. But it is also the other type of small business plan. With that said, the contributions that you're making into these two plans, just as with the traditional and the Roth IRA, everything will grow exactly tax exempt, just like they will in the traditional or Roth. But as with the traditional and Roth, the deductibility is going to be where you're going to see the difference. Now, these two are going to be operating similar to a traditional IRA in that they are deductible contribution type plans, and that when you take money out of them ultimately in the end for retirement, you will then have to pay taxes. With the SEP IRA, it is made up wholly of a salary deferral portion, meaning that you have 25% of your base compensation up to $53,000 that can be added in on an annualized basis for that plan. However, with a simple IRA, that number is reduced to $12,500, the other portions of that being made up more similar to an individual 401k in that you have a profit sharing match from the company, making up the remainder of the contribution for that plan. So depending on what you're looking to do, where you're looking to take a deduction, that's really going to drive which kind of plan might make sense for you. And ultimately, any of these types of plans being put up here can all be used for the different types of self-direction and especially lending as well. The other type of individual plan that we offer for small businesses is the individual 401k. One moment, someone else is having an issue with. Okay, so with the individual 401k plan, it operates differently but slightly similarly to the simple IRA in that you have a elective deferral portion that you are putting in out of your paycheck, which is going to be a deferral that you are making of up to $18,000 if you are under the age of 50 and a half. However, if you're over that, you do get a nice perk in that you can add an additional $6,000, bringing yourself up to $24,000 of profit sharing elective deferral of your paycheck into that plan on an annual basis. But the other cool thing is that you still do get a profit sharing match, and that is going to be up to $35,000. So you can get a significant amount of money put into an individual 401k plan. And the nice thing about a 401k plan, especially on top of that, is that you have the option to make it a Roth plan. So you can make your elective deferral of up to $24,000 in there as a after-tax contribution. So the power of the individual 401k really can't be understated, and we're certainly happy to help you dig into whether or not you qualify for one and how to get one started if you are a small business owner. So it always is a good thing to take note of that. The two smaller plans on the bottom right, because of the contribution limits and the liquidity requirements that people typically want to maintain with those accounts, they aren't as readily self-directed as most other types of plans. However, you can self-direct them. An education savings account is a deductible contribution plan that you get tax-free distribution so long as you are making qualifying higher education payments out of. You can only add in $2,000 a year, so those plans typically are a lot smaller. And with state-sponsored plans and other types of governmental-sponsored plans, you can, also save for that. So they're not as widely used, but if certain types of investors really like to use them for self-direction, you can. Health savings accounts are a similar fashion with a higher contribution limit. If you have a qualifying high-deductible healthcare plan, you can add up to $3,570 on an annualized basis for an individual, and $7,570 for individuals that are covering a family for that. But most people like to utilize those for paying qualifying medical expenses, but you certainly can use that to self-direct. It's just a matter of what your ultimate strategy is. So now hopefully I didn't put too many people to sleep with talking about contributions, deductibility, and plan choosing. So now we're going to get into what people probably most likely are attending for today. We're going to be getting into the investment options. Okay, thank you, Andrew. I will certainly be happy to answer that question. However, not exactly sure, as I'm not familiar with some other the company's offerings. I'm certainly happy to do some research and follow up with you later as to the differences in services. But without knowing some specific details, I can't really answer that very completely. Okay. Investment options. Now, I could put all of the investment options on here, but I would literally be typing for 3 days. So here is some of the most common types of investments that we see our clients do. Real estate in one form or another makes up about 70% of what our clients do. That does encompass notes and mortgages, which we'll get into in a minute with some case studies. Now, real estate in and of itself, that includes people that are doing buy and hold, fix and flips, rentals, anything else like that. So with that said, that is a large locus of what we're actually looking at, and that also does include the single member LLC, which is becoming an increasingly popular vessel to funnel your self-directed IRA investments through. We'll get into that, and there's actually a question that was posed a little bit earlier that with regards to that, so we will get to that here in a moment. People invest in private placements and stocks. You can also do foreign exchange trading. Other types of investments include everything from oil and gas rights to tax certificates, timberland, commercial properties, convertible notes. There's a whole myriad of things out there that are really available to you with outside just the spectrum of real estate. So even though we will specifically be covering in our case studies, we will be looking at notes and mortgages. Just understand that there is a much wider variety out there for you to invest in a self-directed fashion. Okay, we've got a good question from a buddy here. Can I do stock option trading with an IRA? Yes, it kind of depends on what options you're looking to trade. Now, with some large brokerage firms, they may have a platform for you to specifically do that in an IRA at that company. However, with some types of options and futures, they don't offer an IRA in-house, so you have to use a self-directed IRA administrator to open that type of account. So we have clients that specifically want to do certain types of options trading. Maybe it's some type of option product not offered in the United States. Maybe it's an option product that is, simply there's no one writing an option contract for that that's based here, or the companies that are based here that do it don't offer IRAs. So there are certainly a very wide variety of people that do this, and depending on what type of options you're looking to do, you can always do that within an IRA. It just depends on where you're holding that money. So thanks for the question, buddy. Let me just mark that as a question. Okay. And before we get started, at least on the practical side of doing case studies, let me address one other question that we did have. Now, on my previous slide, I indicated that people had increasingly started to use single-member LLCs and other types of investment vehicles under an IRA in order to invest. Now, before I answer Karen's question that was posed in the beginning, just a little bit of background on what exactly that is. So, in the very beginning of this presentation, I showed you the three steps on how to get started. You open the account, you fund the account, and you choose the investment. Well, instead of doing one of the types of investments like right here, directly under the IRA, so the IRA holding direct title as such, so the title of the piece of real estate being Advanta IRA Services LLC for benefit of your name and account number, what you would do is you would form a single member LLC, provide the operating agreement to Advanta. That wording, the Advanta IRA FBO client's name and account number, would be used as the member, so we would help you establish the member as the IRA, the owner of the LLC as the IRA. Then the management of the company would be as a manager-managed LLC, whether that be you as the client or some other individual that you trust. So that's how the actual investment would be set up. The monies would be transferred to the checking account of the LLC, and then all of these subsequent investments specifically for the IRA would be done on behalf of the LLC. So it's basically having the checkbook control. If anyone's familiar with that or has done some research, that is what that specifically is referring to. Similar functions can be also achieved with a trust, but I have separate presentations on that whole line of investment options. Now, with the single member LLC, you do have more control. You have checkbook control, but it also brings up some other considerations. So Karen asked, can a husband and wife each with their own checkbook LLC loan to each other? Unfortunately, no. You can't structure that as a loan to one another. If you each have individual LLCs or individual IRAs, one of those entities cannot lend to the other because they are prohibited individuals from one another. I typically get to the prohibited individuals at the end, but now's as good a time as any. The disqualified individuals from your IRA dealing directly with are anyone that is directly up or down from you in your family tree. So you can't directly purchase or sell a product or sell an investment to your mother or father, to your spouse or your son and daughter. The IRS in their opinion does not consider a brother or sister a disqualified individual, but that's for whatever reason they think that. So just because you cannot lend to each other doesn't mean you necessarily can't do deals together. So instead of structuring that as a loan, structure it as a partnership. So you can partner with a disqualified individual all day long. You just can't directly be on opposite sides of the closing table. So instead of you lending with your LLC to your husband's LLC, partner the LLCs together. So bring them together and say, hey, since you don't have enough cash over there to get the deal done, let's partner together and do it as a tenant in common purchase. So XYZ LLC and ABC LLC would each be titled on the title of whatever asset they're purchasing. It would be ABC LLC as to a 10% undivided interest and XYZ LLC as to a 90% undivided interest. And all expenses and income would be split along those percentages of interest. So just because you can't necessarily do a direct loan or a direct sale to a disqualified individual, such as a husband or wife or son or daughter, doesn't mean you can't make the deal work. So always understand that. Reach out to us. Ask the questions because we can try to help you understand that there's other ways of going about it that will keep you on the right side of the IRS, but not necessarily in the way that you initially thought that you wanted to structure the deal. So Karen, thank you very much. And that also goes to show, ask the questions because it does bring up other good points that people will find useful. So thank you, Karen. Okay, one moment. Dorothy has another question. If you have a single member LLC, can you then invest in real estate and let family member be a renter? Yes, indeed. Unfortunately, you cannot have them be a renter. You can't derive any sort of income or benefit from a disqualified individual, again, being your mother, father, son, daughter, or spouse. But thank you very much for asking, Dorothy. And I do apologize. It seems a few people are having audio issues. Again, everything will be on YouTube if you can't hear the audio, so I do apologize, but I do think plenty of people can't hear. So getting back on track, how do you find the deal? Since Advana is a company, we don't provide any investments for you. We don't have a list of stocks. You can't say, I'd like to buy Microsoft, I'd like to buy Google or Apple. How do you find the investment? What do you do? The biggest thing I tell people is use your network. If you're doing something, that works, translate that to your IRA. If you're great at doing rentals and you want to get involved in self-directing your IRA, maybe not the best time to try your hand at private equity investments. If you're great at picking out a lender outside of your IRA and that's all you do is hard money or mortgage lending, I would highly encourage you to continue to maintain par for the course and utilize that network that you've built and the professionalism that you've exuded through your network of people to help you maintain success in your IRA. So use that same kind of strategy that you're using. Don't try to reinvent the wheel just because you're changing your investment platform. You don't necessarily change your investment strategy. So by extension, using self-direction not only unless you invest in what you know, but with who you know. As corny as that may sound, I think it does very much ring true when you're looking at this type of investing, is that the biggest asset that you have maybe isn't capital cash, but the network of people and the investments that you've done outside of it and your experience might be one of the largest assets that you have that you may not realize that you do. So just like to really hammer that home before we kind of jump into some case studies, and hopefully we get some more good questions popping up here. Shelley asked, when you have a moment, did you say that brothers and sisters aren't considered disqualified? I did. The IRS does not consider your brothers or sisters to be disqualified individuals from your IRA. So what does that mean? That means that if my brother John has a rental house and I say, you know what, I want my IRA to buy that, I can buy it from him. Or if he needs to borrow money, I could lend my brother money out of my IRA, and it'd be a qualified investment. However, and I can't really stress this enough, that absolutely has to be done on a fair market value basis. So if you're going to go and lend him and private money is being lent out at 6% interest and 2 points, don't lend it to him at 1% with 0 points amortized over 50 years. Make sure that it is a fair market rate that you're charging these people, because just because they don't consider them disqualified on face value doesn't mean that you can't get into a direct personal benefit disqualification in that scenario. So making sure that you're dealing with them on a fair market value basis is key, but you can certainly do deals in any capacity with your siblings. The only people that you have to be specifically careful of with regard to your involvement with is your mother, father, son, daughter, or spouse. So thank you, Shelley. I'll just mark that as a question. Okay, so we've covered that you can do investing in any way that you really kind of desire with a self-directed IRA. Now, what does that really mean? I say that you can do all of these different types of investments. Well, how do you do it? What do you do? So finding the investment. The investment needs to be newly acquired. That means that you have to have gone out and found it separately from something that you hold in your personal portfolio or one of the other individuals that we just covered. All assets must have a readily determined value, meaning that anything that you're purchasing with an IRA can't derive its value from collectability or subjectivity. Obviously, everything is slightly subjective in value. I'm not going to go out and buy a house that is located in a horrible neighborhood with a high crime rate. I wouldn't pay anything for it. However, people certainly will pay for that because there is a valid investment there. That type of subjectivity isn't really what we're talking about. We're more focusing on the items that really can be said that they're collectible. So things like rare bottles of wine, baseball cards, artwork, things like that are not allowable investments for your IRA to invest in. There is no readily determined value. It's impossible to say, what they're actually worth. So the IRS disqualifies those from investments. Investments cannot be personally owned, so you have to make sure that anything that you're acquiring is newly acquired. You also can't necessarily say, oh, well, I own this property, I'm going to sell it to him and then buy it back. They do kind of cover that in what's called their step transaction doctrine. All expenses from any type of thing that you're doing in the IRA have to be paid from the IRA. So when you're doing a loan, you got to make sure that the document preparation and everything else is paid for by the IRA if there's an expense for that. As we kind of covered briefly in the beginning, if your IRA is short on funds, consider using partners, just like was asked about with the IRA LLCs loaning to one another. Consider using a partner if you're short on funds. Instead of maybe structuring it with a loan, or if you need to use someone that is, disqualified from you, look at doing it as a partnership. And that goes with lending out as well. So if your one IRA doesn't have enough money to cover the investment that is presented to you, maybe look at bringing in a partner and doing a tenant in common loan out. So you can have two different lenders stated on the note that each hold a percentage of undivided interest in the actual lender side of the note. So just because it's not necessarily something that is being purchased and maybe being lent out doesn't mean you can't divide the interest of holding it. And remember, all income has to come back to the IRA. So you can't take any of the income directly from the asset. It all has to be cyclical on the side of the IRA. So if the IRA lends someone money, it is going to be receiving all of the principal and interest payments from that. The continual revenue stream, disregard that last line. I did not remove it. The continual revenue stream line can be disregarded from this one. But just remember, all IRA income has to come back to the IRA. So buying assets. Now, I kind of briefly touched on this, but the actual title of any of the assets is going to be separate from your name personally. Your IRA is going to be operating as a separate entity from you personally. So that means that the title of any of the assets that is going to be purchased by it has to be done specifically in the name of the IRA. And people that look at this think, well, if I have an IRA somewhere else and it's buying stock, it's in my name. If you actually look at the register on the brokerage firm, it's actually going to be something very similar to this, just like it might be Fidelity, Inc., FBO, John Smith, IRA number for the Microsoft they own. Over here, if you're lending out someone, the title of the lender on the note and mortgage would be Advanta IRA for benefit of John Smith and their IRA. And just like that, because of the fact that the IRA is the title owner of it, all of the proceeds have to come from the IRA if it's the whole owner and not using a partner, and all of the funds that are derived from the investment as profit from the investment have to be flowed back into the IRA as well. And please do remember, it doesn't matter so much of what kind of account this is. So it doesn't necessarily matter if it is a Roth, if it's a traditional, a SEP, simple, 401k, what have you. The only thing that's really considered in this for the tax-free portion of it is the fact that it's coming into a qualified plan. So everything is growing tax-free. So you lent out money, didn't pay any taxes on it. Everything came back in, so all of the interest that you're making, any points or prepayment penalties is all going to be tax-free income to the IRA. The only time you need to consider taxes in this whole scenario is at the very end when you take money out for retirement purposes, such as taking a vacation, doing some remodeling to your house, things like that. That's the only time you're going to have to worry about what type of account it is, because that's when you have to worry about your taxability on those distributions. We're just about ready to touch base onto the actual case studies. I would encourage anyone, I'm going to take a sip of water, please type in some questions. Typically, some people have, at this point may have built up a few. So ask a few questions, and then if, in a few moments I don't have any, we will jump right into the first case study. All right. Doesn't look like we have any questions, so let's jump into the first case study. Okay. Oh, a few just popped up. Oh, we got a. Okay. Well, we got a few questions. So we'll scroll back one slide and we will get these answered. Christopher asked, does Advanta have wiring instructions for proceeds to be sent to the IRA account? Certainly we do. We can provide wiring instructions, or they can do direct deposit ACH to your account, or they can send a paper check. It doesn't matter how the borrower or renter or how money needs to be sent to us. We offer a full suite of banking services, so we can certainly accommodate however you would like to go with your account with that. Definitely not a problem. Okay, Shelley asks. Okay, Shelley asks about the training or seminar regarding LLCs and trusts. Certainly, I did a webinar on that not too long ago. It should be on our YouTube channel. www.youtube.com/Advanta IRA, or if you go to advantaira.com, it'll link you over there. And I'll certainly look. I captured your contact information when you signed into this, so I can certainly look into that, Shelley, and try to see if I can pull that recording directly and send it over to you, or at least a link to where you can look at that. Andrew asked if you do have any questions about our fees or how we operate. The Advanta IRA account application that you can get off of our website does disclose all of our fees, or if you want to have a one-on-one conversation, feel free to give me a call afterwards and I will be more than happy to go through exactly the functionality of the account and exactly what it costs to get started. Happy to do that, but that again is just, it's a long, very in-depth. I need to understand what you're doing to give you an accurate quote. Buddy asked, how does an IRA become a real estate holder along with a mortgage? Buddy, and I'm not sure, I might be misunderstanding the question or just not grabbing it wholly. Are you talking about how does an IRA buy real estate with a mortgage, or how does it buy real estate and issue a mortgage? Two kind of different ways to go with that. So if you could clarify a touch, I would be happy to answer that. Just wait one moment. Okay, so with regard to the IRA buying property and acquiring financing, unfortunately, it's also another really in-depth answer, but essentially it boils down to an IRA can certainly borrow money. An IRA can finance a purchase of any type of asset. However, it has to be done correctly insofar that the IRA is receiving and signing for a non-recourse note, meaning that the note lender is agreeing to hold the IRA non-liable for anything past just the security on the note. So basically, if the IRA borrows money, that means that the lender can only come after the security, be it the property or what have you, in the event of default. That's only if you're borrowing money. The IRA lending money out as a mortgage, you don't have any sort of restrictions on it being recourse, non-recourse, secured, unsecured. That's completely the prerogative of the client as to the security and the recourse that is issued by the borrower to the IRA if it's lending out. But Buddy, specifically, if you are using financing to buy a new piece of property in the IRA, it does have to be non-recourse. So thanks for the question, and I'm happy to get into that. That's a very in-depth, more of a kind of a technical answer that kind of goes along with that for some additional considerations. So if anyone has any questions about non-recourse financing, if you're looking to do leveraging, so your IRA borrows money, happy to do that. Just reach out to me with my contact information at the end, and we can certainly have that conversation. Okay, moving on. So first case study, and all the case studies I've pulled from the basic tenets of what I've seen clients do. Obviously, exact figures have been rounded and names have been changed, but I have actually seen people do these exact same kind of things. So use this as a good reference as to what people are really doing in the world of self-direction. We don't endorse or guarantee any sort of returns, and this is just for illustrative purposes, but it is a good real-world example of exactly how this kind of stuff works. So with 123 Main Street, Jake James identified a property being sold as a short sale. He had an offer accepted at $120,000. Now, just as I said, invest in what you know and who you know. Jake knows John Smith is a lender, and he John Smith does not do any sort of, buying himself. He only likes to lend money. So Jake works with John to acquire financing for the investment property. So John Smith looks at the numbers. He goes over everything. He knows Jake. He's, had a good working relationship with him for years. Feels comfortable lending him the money out. Now, the going rate in this area is 8% amortized over 15 years, so that's what they both decide on. And the other cool thing that really is, undervalued in the whole realm of self-direction is that not only are you choosing your investment specifically, but you're also choosing your rates of return. You're choosing the amount of risk that you want to put out there. So you really do get a much tighter control of everything, because John and Jake came to the agreement that, that was what John Smith felt comfortable getting in return, and that's what Jake felt comfortable paying out. So he is completely dialed in exactly what his rate of return will be. And then also the security in this instance is that if Jake fails to pay him, John will foreclose on the property and then take that back into the IRA. All of the interest is not taxable to John's IRA. It's all growing tax exempt, so he's getting more capital quicker than he would outside of the IRA, because outside of the IRA, you might be getting hit with ordinary income, capital gains, whether that's short or long term, depending on when the payoff is. You're avoiding all of that, and the nice thing is you're not having to do any sort of carry forward calculation for capital gains. So everything that's coming in and growing in your IRA is completely tax exempt, and you're not having to do any sort of long-term accounting. It's just tax exempt growth in the IRA. And remember, the only time you have to consider Roth versus traditional versus anything else is only when you're taking money out at the end and only when you're putting money in the beginning. So this is a good snapshot example. I do believe the example I used for this, the guy is still making payments on the loan. So I think this was about 3 years ago. So do the math. He's getting, a good return. Jake's happy because he got financing. John's happy because he's getting money paid out. So, you can really make a good, amicable investment that not only is the person that is taking the money out of your IRA happy with, but you're happy with the return coming in there as well. So there are a bunch of different types of loans out there. You don't have to necessarily do, the most black and white types of these things. The two most common that you're going to see is a mortgage, meaning that you have a security backing the actual loan. A mortgage does not necessarily mean real estate. It means that you have an enforceable lien against a piece of property. That property can be actual real estate. It can be capital equipment. You can securitize or collateralize, say that 4 times fast, the loan with whatever you deem fit, so long as that it's not a personally owned asset of yours. Why that would apply is not necessarily relevant, but so long as that it's something that can be collateral, you can certainly work with the borrower to make sure that that is amicable for the investment. Just keep in mind that if your IRA does have to foreclose, then you're going to have that type of asset within the account. Does that make sense for your IRA investing? That's kind of for you to decide. But you can do mortgages all day long in your account. And it is certainly a very popular one. Unsecured loans, just because you want to lend money out to someone and maybe they don't have collateral, or maybe the reason they need the money doesn't inherently lend itself to giving a collateral past a personal guarantee on the note, doesn't mean you can't do it. We have many clients that do various forms of unsecured notes. So the unsecured loans will range anything from just a personal loan to someone for XYZ expense I have, to things that are on a little bit more of an interesting basis, such as equity participation in a real estate project. And actually one of the case studies is directly on equity participation in here. And that's kind of a cool caveat that people are starting to use more, that I find very interesting as well. You also have the ability to lend to a business. You don't have to lend to an individual. So the person on the other end of the money that you're sending out of the account doesn't have to be, doesn't have to have a pulse, essentially. You can lend to a business or entity. So if, there's a restaurant down the street that the owner of, and they're short on payroll and they need to take a loan out, you can lend to them. You can also lend to investors as well. So it doesn't have to be, for anything specific. The need for the money is not what drives the ability to do this type of investment. They can really need it for anything that they want. obviously you need to be lending to someone for something legal, but it kind of goes without saying. But you can lend to anyone for anything so long as that you both can come to the agreement on the amicable terms of the actual investment itself. So long as you can do that with whoever is borrowing the money and both of you are comfortable with it, you can typically do that deal within a self-directed IRA. So just remember that it's not so much of the need for the money or anything else like that. It's more to the terms of the loan that really kind of make it work, and making sure that the loan is to a qualified individual. So no mothers, no fathers, no sons or daughters can't be borrowing the money. So long as it's to a qualified individual for, an agreed upon term, you can make it work. Okay, so here's another example. So a high volume client of mine in the past has used the strategy of having investors throughout the area in Florida that his Roth IRA acts as the lender to. All the loans are secured by a first or second mortgage. It does not have to be senior debt. You can have a subordinate position to a loan if you want to. If you're okay with the risk of being second in position to get paid out if there's any issues with it, that's fine. But this individual felt that it was best to get some type of security if they couldn't get first for lending out. All of the interest and the payoffs are not taxable. Remember, they're going back into the IRA, so there's no taxes paid on any of the interest, any of the prepayment penalties, any of the initial points up front on the mortgage. Nothing is being taxed at that time. It's all tax-exempt income to the IRA itself. And oddly enough, one of the largest accounts at Advana does only lending. So it goes to show that, different strategies can produce different results. And this individual has done, very well doing lending. So there certainly is a lot of opportunity out there for you to, make this work if it's something you're very interested in. And we're certainly here to help in utilizing our experience and knowledge in the area to help you kind of hash out and figure out which is the best strategy for you. So equity participation, the one that I kind of indicated was one of the more interesting to me. Having a background in finance was coming out of college, I'd seen, the basic textbook of some of these things. Here's a mortgage, here's, stocks and bonds and everything. But the really cool part about my job is that I get to see a lot of the nuts and bolts of the super creative investors that come to us. And one thing I've been seeing a lot more in the past years is the concept of doing equity participation in a project. So what does that mean? The people that are familiar with it are very familiar with it, and the other people probably aren't. So to kind of give the basic overview of what equity participation is that when you lend someone out money, there's always going to be some sort of consideration for the money. So the consideration typically is going to be an interest rate. So they're saying that over a certain period of time, I will repay you at a certain percentage of the principal you lent me until I have paid off the principal amount, and that percentage will be commensurate with how much outstanding principal is still left on the note. With unsecured equity participation or secured equity participation, the consideration is not given in a standard monthly payment that is going to be made up of either interest only on the principal lent out or principal and interest payments. The consideration is going to be a percentage of the profits and the sale of the property that underlines the loan. So what does that mean in simple terms? That means that when you lend someone the money in this circumstance, you typically are not going to be receiving a principal and interest payment, or maybe payments at all through the term of the loan. You will only get repaid once the property sells, but instead of making 6 or 8%, people typically charge a much higher percentage for this, saying that you pay me back my principal of $50,000 plus 20% of the profits that you made when you sold the property. So a very interesting concept. And then, and what's presented here on the slide, Jane knows a contractor that flips properties. Typically the people that are borrowing these types of things are flippers or contractors or people like that. She lends the money to the contractor for the rehabs. The IRA actually received no payments until the property sells, at which time the IRA received the full amount that it lent out, plus 20% of the profits that the individual made when they sold the property. So if the individual borrowed $50,000, bought a property for $100,000, and then sold it for $150,000, she would get 20% of $50,000. So, the amount of money that you can potentially make in a scenario like that is very interesting, because it's directly tied more so to the property value than it is just the fixed rate of return. And obviously with a note and mortgage, you are tying yourself to a certain fixed rate percentage and not necessarily always enjoying the upside of a real estate market. So this kind of lets individuals get involved with the property values that seem to be increasing in some areas very much, while also still having the ability to lend out money and not take on the liability of actually owning the property and title. So a few closing things that I'd like to make sure that people understand from this. Rules and considerations for your self-directed IRA. Issuing a loan to your daughter. They're directly up and down from you in your family tree. Mother, father, son, daughter, disqualified. You can't issue a loan directly to her. You could partner with her on a new deal. If your daughter is an investor and you want to, or maybe start helping your children start investing, you could partner with them. They bring money to the table, you bring money to the table, and then it goes out. You could certainly do that. Identifying and qualifying your borrower. You're absolutely allowed to do this. Just like you're allowed to pick your own stocks at Fidelity, you are the one that's going out there and ultimately identifying the investment, and that's in this case the person and the property that you're lending the money out to. So accepting payments outside of your IRA. If your IRA is involved, whatever percentage it's involved in the deal, it has to receive that money. So if it's 100% holder of that note, it has to receive 100% of that monthly payment. If it is 50% owner of the note, then it's going to get 50. You can't necessarily take that money in outside of the IRA, deposit it, and issue a check back to Advanta. It has to be collected directly by the individual or entity, in this case the IRA, that holds the proper interest in that note. And can you issue an unsecured loan? Absolutely. There's no regulation that says that you have to do a certain type of lending within an IRA. You can do whatever makes sense and whatever is agreeable between you and the person borrowing the money. So with that said, I'll open it up to Q&A. We're getting down this about 5 minutes early. I'm happy to stick around and answer any questions that people might have. So please, I will stick around for a while, so long as that there's people signed on. Here's my contact information for any of you that had questions that I couldn't necessarily get to during the presentation. Feel free to shoot me an email, get in touch with me. I am happy to be a resource for you. We've got a couple questions popping up. Okay, here we go. Buddy asks, what kind of agreement would you use for an equity participation note? I've seen different types of things. Typically, what I've seen is it has been written into the note itself as to the participation in the equity. I would encourage, if anyone's interested in doing that, run it by an attorney, pay for an hour of their time and say, hey, if I want to do this, what's the best way to make sure I'm protected and my IRA gets the consideration it needs for the money being lent out. So, an hour of an attorney's time to make sure things are done right, definitely money well spent in my eyes. But I've seen various different structures of it. Sometimes it's an ancillary agreement between the holder of the note, the IRA, and the borrower. Sometimes it's written into the note. There's different ways of doing it. It's just whatever works best for that situation. Shelley asked, if you have a 50-50 partnership, will 100% of the income go to Advanta and then Advanta send the 50% to the partner? It depends. If the 50-50 partnership is with 2 Advanta IRAs, or 3 or 4 or 5, like I've seen, we can accept one payment and then split it among the people that are account holders. However, let's say it was you personally that partnered with your IRA or another third party, we would only need to receive our portion of that. We couldn't necessarily receive the whole thing and then kick out another check to someone. But I would encourage in that if you're doing lending and you have multiple people like that, you could consider utilizing some sort of a loan servicer where they receive everything and kick it out. There's different ways of certainly doing that. Nellie asked, I am currently in a note program receiving interest distributions. The return is just sitting in my account. What would be the best way to reinvest? I'd love to be able to answer that for you, but unfortunately, as we are not investment providers or financial planners, I can't necessarily answer that for you in your own personal investment situation. If you're happy with where you're at, consider contacting the company and seeing if you can do another self-directed reinvestment with them. If that's an option you'd like, you can certainly look to doing other types of loans or self-directed investments. There's different options out there. Just a matter of what you would like to see as the return and where you want to put your money. Give us a call, and we're certainly happy to go over those specific options that you would have, or what might make sense for you and the best course of action for that. But give us a call, and we will certainly review that in more detail with you. Thanks. Let's see. Andrew asked about the custodian model that we use. Yes, we do utilize Mainstar Trust as our back office custodian. The nice thing about that is that we are able to offer better pricing and a more local feel with utilizing that business structure. The exact same different type of services can be offered by IRA administrators, first custodians. The only difference is inherently in whether or not they want to go through the expense and the actual filings to be an actual trust company. It's a business decision that we utilize Mainstar Trust. We have a great working relationship with them. They work with many different trust companies and IRA administrators for us to be able to offer this great local service to our clients. Thanks, buddy. Again, I do see people signing off. If there are any questions, I am sticking around for a little bit, so feel free to get them typed in. Happy to answer them. I'll probably be signing off officially at 1:05, so if you have any questions, get them typed in. We'll get them answered. If not, just shoot me an email or give me a call, and I will certainly get that answer for you. Christopher, yes, we do have an office in Atlanta. It is in Buckhead. Thank you, Shelley. Thanks, Sherry.